Hi, this is John Prasinos, Editorial Director of Investing Daily, with the video presentation for Monday, November 8. Be sure to visit our website at investingdaily.com. Also visit the website of our subsidiary, streetauthority.com. Well, we're witnessing the Rodney Dangerfield of rallies. This bull market can't get no respect. In our highly partisan post-truth era nowadays, people embrace all sorts of lies and conspiracy theories. The following arguments are gaining traction in the media. Perhaps you've heard them. You probably have. The economy is imploding. Domestic energy policy is driving up gasoline prices. Government profligacy is creating hyperinflation. My verdict on all 3 points? Wrong, wrong, and wrong. The truth is, economic growth is accelerating. Soaring oil prices and the concomitant rise in gasoline prices are the result of supply and demand imbalances caused by the pandemic, and inflation largely stems from pandemic-induced supply chain distortions and bottlenecks that will soon get ironed out. As underscored by the hard data, a bullish stance, alloyed with caution, is warranted. The first trading week of November started auspiciously, with the 3 main U.S. stock market indices closing at record highs. Equities posted their best weekly return in more than 4 months. See the following chart. The Federal Reserve's judicious plans for tapering, a healing jobs market, robust corporate earnings, falling pandemic infections and deaths, and the emergence of a promising new COVID pill are all combined to cheer investors. In what should prove another tailwind for the financial markets, the House on Friday night passed President Biden's $1.2 trillion infrastructure bill. Biden will soon sign the bill into law, guaranteeing the sort of fiscal stimulus that Wall Street and the business community likes. See the next chart. The Build Back Better bill addresses America's long-deferred infrastructure repair needs, which is a huge win for the shares of construction and building companies. Meanwhile, the Fed last week didn't announce anything that isn't already priced into the stock market. Fed Chair Jerome Powell said the central bank will start to wind down, aka taper, its monthly pace of bond purchases, currently at $120 billion, by $15 billion per month. That means the Fed will have finished shedding its purchases by June 2022. It's worth noting that tapering is not synonymous with tightening. The Fed will continue to inject stimulus over the next 8 months, but at a diminishing pace. Robust consumer spending is upping the demand for goods, but supply chain snafus and transportation bottlenecks are driving inflation higher. However, like Powell, I think that inflation will eventually moderate as supply chain woes ease. The economic news has been good. The Labor Department announced last Friday that the U.S. economy added 531,000 jobs in October, as the unemployment rate fell to 4.6% from 4.8% the previous month. The number of jobs added in October increased by 219,000 from the previous month. Take a look at this chart. According to the Labor Department, quote, job growth was widespread, with notable job gains in leisure and hospitality, in professional and business services, in manufacturing, and in transportation and warehousing. Employment and public education declined over the month. End quote. For comparison, in January, the unemployment rate was 6.3%, and jobless claims were coming in at the very hot rate of 900,000 a week. As the wave of Delta variant infections have ebbed, job gains in hospitality and leisure have picked up. These service sector improvements should accelerate into 2022. Another bullish factor arrived last week with the latest reading of the Purchasing Managers' Index, the PMI, which jumped to a record high in October. That said, risks remain. Inflation could get a lot hotter, COVID could make a comeback, and political paralysis in Washington could make it impossible for Congress to achieve anything beyond the infrastructure bill that just passed. In the week ahead, keep your eyes on the following economic reports scheduled for release. Initial jobless claims and consumer price index Wednesday, and 5-year inflation expectations Friday. With inflation on everyone's minds, the latter report is likely to move markets. There are plenty of reasons to stay bullish, but you also need to stay selective, and that's where our Investing Daily analysts can help. Our investment team has unearthed a tech play that's poised to take off, but it's flying underneath Wall Street's radar. To learn the details about this rare money-making opportunity, visit the following URL. Well, that's it for now. Thanks for watching. Stay invested and please stay safe.